How should investors think about this ongoing fight against inflation? Let's bring in Kathryn Rooney Vera. She's Chief Market Strategist at StoneX Group. Nice to see you, Kathryn. Good morning. Appreciate the time.
Thanks, John.
I know that you've been pretty cautious, and part of your cautiousness it ties back to this looming uncertainty about where the economy goes with this ongoing fight against inflation. Let's start with what you think the market will see in the inflation report this week. Any bets there?
Well, the market is anticipating, and rightly so, a deceleration, and a meaningful one, to about 3%. 3.1 is consensus. My forecast is at 3.0%, and that is just a blip on the radar. That is nearly entirely due to base effects, principally from the oil space a year ago. What I'm more looking at is what the acceleration will be in core services. We see goods decelerating, and that's great, but the biggest threat to the Fed's 2% inflation target, John, is no longer good prices, it's services prices. And that's where I think the heat is going to remain on.
So we just had a conversation about the fact that the Bank of Canada is likely going to raise interest rates again later this week. When the Fed meets again, what do you think that central bank will do?
I think it's widely expected that the Fed will hike another 25 basis points in the month of July. Now the question is, do they hike again in September, in November, in both, or in neither? And on that front, there is no consensus. Each analyst has his or her own perspective. Of course, it will depend on the trajectory of inflation, specifically super core. The housing market has really not moved in the direction that many of us would have anticipated after 500 basis points of rate hikes over the past 12 months and a 30-year mortgage rate that has once again topped 7%. Housing prices still remain sticky. Rents are decelerating, but they remain, housing and shelter costs remain a principal driver of inflation. And my view has been, John, that we need to get consumption to level off, or consumer confidence to drop at least somewhat, before we can really expect that 2% inflation target to come close to being hit.
And I guess for a lot of people who are trying to figure out what this all means for the stock market, especially in a year where investors were really jumping in a big way to technology stocks, the AI boom, we talked about that last time you were on. What's your advice to investors right now?
Do not chase the market is my advice to investors. The Wall Street Journal put out a piece that I retweeted yesterday, John, which I think is an ominous sign, where you have an increasing number of retired persons chasing the market and overloading their retirement portfolio with equities. This is a dangerous thing to do, especially for this cohort of society. So yes, year to date, the market has shocked us all. None of us, very few of us, analysts on Wall Street, expected the S&P to rocket higher, led by technology, especially in an environment of high and rising rates. The Fed is close to its end of its tightening cycle, but it's not there yet. The Fed could hike another 25, 50, or even 75 basis points. The truth is, and as you mentioned, the Bank of Canada, the Fed could surprise, and it depends, of course, on the data. That said, if the Fed does continue to hike, that's not good for the cyclicals. It's not good for consumer communication services, technology, discretionary. So I would be very wary of chasing the heretofore outperformers and be more cautious. Look at money markets, look at T-bills, look at short-term treasuries. You can get very nice yielding rates on those risk-free assets in cash. So have a solid proportion in cash ahead of the next phase of the economic cycle, John, which maybe it's not this year, I think it's 2024. But in my view, to get to the 2% target, unfortunately, it is going to require an economic contraction.
Now, you talked about a few different pockets of the stock market. I do want to mention banks, or get your perspective on banks as well, because as we roll through this week, we're going to start hearing from some of the money center players. Their businesses obviously are in better shape than some of the regional banks. It really came under pressure earlier this year when there was a fear that these higher interest rates would literally break more regional players. We saw a couple of those players crumble. What would be the biggest question you're asking if anyone's curious about the financial sector at this point?
Well, how soon until the yield curve meaningfully steepens? We have a 2s, 10s, that's the 2-year Treasury versus the 10-year Treasury, that's still enormously negative, so about 100 basis points negative. Once we get a stabilization, and we have seen somewhat of a stabilization on that front, and a steepening of the yield curve, that would of course be positive for banks. I would be again cautious, however. Banks are not a sector that historically outperforms in a recessionary phase of the economic cycle.
Okay.